Hey everyone, and welcome back for another deep dive. Today we are looking at a really interesting piece of Singaporean tax law and how it defines related parties in transfer pricing.
Sounds pretty niche, huh?
It kind of is, but it's really important if you're doing business in Singapore, especially if you're dealing with companies that might be, well, connected. Think about it like this.
hmm
If two companies are like siblings, how do we make sure they're playing fair when they're, splitting the money? That's where transfer pricing comes in.
Right. And in Singapore, they take this concept of related parties pretty seriously. You got the arm's length principle, Section 34D of the SITA, which says those transactions got to be priced like they're dealing with strangers.
Exactly. And then you need all the documentation to back it up, Section 34F.
Lots of paperwork, but hey, that's the price of transparency, right?
For sure. So today's deep dive is all about figuring out how Singapore actually defines these related parties and why that definition matters so much.
Let's get into it. Okay, so we've got an excerpt here straight from the Singapore Income Tax Act, the SITA. And it says, a related party in relation to a person means any other person who directly or indirectly controls that person or is controlled directly or indirectly by that person, or where he and that other person directly or indirectly are under the control of a common person.
Wow, that's a mouthful.
It is, right. So basically, it all boils down to control. Who's really calling the shots? That's what they want to know. And what's really interesting is that the SITA doesn't set a specific ownership threshold for related parties. Like some countries say if you own more than 50%, boom, you're
It
related.
makes you wonder why they don't have a specific number.
I know. So instead of just looking at the numbers, Singapore really digs deep into the relationship between those companies. They want to understand who's pulling the strings, regardless of how much they own on paper.
So, imagine this. Your company owns a tiny piece of another company, let's say 10%, but you've got this huge influence over their decisions. In Singapore, you could be considered related parties, even with that small ownership.
Right, and that's something that a lot of businesses might overlook. They might think, oh, we only own a small stake, we're good. But in Singapore, it's not that simple.
And it gets even more complicated when you bring families into the mix.
Oh, tell me about it. The SITA even mentions close members of a family potentially being considered related parties, even without direct ownership.
So you got family businesses where maybe someone isn't officially on the books, but they're still the puppet master. Adds a whole other layer of complexity, right?
Absolutely. And this is where things get really interesting for companies operating in Singapore. Because you got to think, how does this definition of related parties, which is super focused on control and influence, how does that compare to, say, the accounting world? I mean, accounting standards like IFRS, they also have their own definition of related parties, right?
Yeah, and it's not always the same. It's kind of like wearing different hats,
hmm
What works for your accountant might not fly with the tax authorities.
Exactly. And in Singapore, when it comes to transfer pricing, the SITA definition is the one that matters. Companies need to keep that in mind.
It's like the SITA's got the final say.
Okay, so we've talked about how Singapore defines related parties. It's all about control, not just ownership, and how that can be pretty broad. But what does that actually mean for businesses? How does that play out in real life?
Well, it can create some pretty tricky situations, especially for these big multinational companies trying to, set up shop in Singapore.
Right, because they've got subsidiaries and joint ventures, maybe even informal partnerships with local businesses.
Now,
Where do you even begin to untangle all those relationships?
and then on top of that, you got to figure out if they fall under this, related party definition. It can be a real headache.
It's more than just ticking boxes on a form, right? You really have to understand the dynamics of each relationship to make sure you're playing by the rules.
Exactly. And if you get it wrong, oof, the consequences can be pretty serious. Tax audits, penalties, even damage to your reputation.
Yeah, nobody wants that.
And remember that arm's length principle we talked about. Companies need to be able to prove that their transactions with related parties are priced the same way as if they were dealing with, a complete stranger.
So it's like you're under a microscope.
Kinda, yeah. So how do companies actually navigate all this? What are some practical steps they can take?
That's the million-dollar question.
Well, first things first, you got to do your homework. Thorough due diligence is key.
Due diligence, meaning...
Meaning you really got to scrutinize those connections you have with other businesses. Look at ownership structures, how control is exercised, even the influence of certain individuals or family members. It's about getting the full picture,
Plus, you're not just looking at the financials, you're looking at the human element, too.
Exactly. You need to dig into both the legal side and the operational side. It's not just about crunching numbers, it's about understanding how decisions are made and who's really calling the shots. And a lot of times this involves different teams working together, legal, finance, operations.
Got it. So let's say a company has figured out which transactions involve related parties. What happens then?
Then, my friend, documentation becomes your best friend.
Paperwork. Here we come.
Well, yeah, but it's important paperwork. Singapore requires businesses to keep these detailed records that show their related party dealings are arm's length. Basically, you need to be able to prove that the price of those goods, services, whatever's being exchanged, is in line with what independent companies would agree on.
So this documentation, what does it actually need to include?
It's pretty comprehensive, yeah. Usually includes something called a functional analysis.
A what now?
A functional analysis. Basically, it outlines the roles and responsibilities of each party involved in the transaction. Then there's a comparability analysis, which compares the pricing to similar transactions between unrelated parties. And of course, you need a clear explanation for how you arrived at the price.
So this is where the rubber meets the road. This documentation is what proves a company is actually following the arm's length principle, right?
You got it. It creates transparency and shows the tax authorities that the company is playing fair. No funny business.
But here's the thing. We've been talking a lot about Singapore, but this whole issue of related parties and transfer pricing, it's a global thing. What about other countries? Are there big differences companies need to be aware of?
Oh, absolutely. While the main ideas behind transfer pricing are pretty much the same around the world, the specifics can be wildly different.
Makes sense.
Yeah, like different countries have different definitions of what a related party is, and they can have totally different rules about documentation. Some might be super strict about how much ownership you need to be considered related, while others might focus more on control or influence, like Singapore.
So companies that operate in multiple countries can't just assume that what works in one place will work everywhere else.
Nope. It's like navigating a minefield. You need a map for each territory.
And probably a good guide too, right?
Oh, for sure. That's where expert advice comes in handy. Thorough research and expert advice are essential to make sure you're compliant in every country you operate in.
It just shows how important it is to stay informed and keep up with all the latest changes in transfer pricing. It's not a static thing. The rules are always changing.
Couldn't agree more. Staying ahead of the curve is key if you want to avoid headaches down the line.
So before we move on, let's just quickly recap what we've discussed so far. We've learned that Singapore has this broad definition of related parties that can be quite challenging, especially for multinational companies. We've also talked about how important due diligence is in untangling those relationships and how crucial documentation is in showing that you're complying with the arm's length principle. Okay, so we've talked a lot about the challenges, right? All the things that can go wrong when you're dealing with related party transactions in Singapore. But I gotta ask, is it all doom and gloom? Like, are there any upsides to all of this?
Oh, for sure. I mean, it's easy to get caught up in all the compliance stuff, but we shouldn't forget that these relationships can actually be pretty advantageous for businesses.
So tell me, how can companies turn this potential headache into something that actually works in their favor?
Well, think about it. Multinational companies, they've got this huge global network, right? And they can use those related party relationships to their advantage.
How so?
Like, they can optimize their supply chains, make their operations more efficient, even tap into new markets more effectively.
So it's about looking at the bigger picture and using those connections to be more competitive.
You got it. And by carefully structuring transactions with those related entities, companies can actually reduce costs and improve their performance overall. It's like a secret weapon, kind of.
Sounds pretty good, but I imagine it takes a lot of finesse to make it work. You got to get those benefits without, stepping on any toes legally.
Absolutely. It's a balancing act for sure. It's not about finding loopholes or pushing the limits. It's about being smart and staying within the lines of transparency and fairness.
So how do companies make sure they're doing it right?
Well, the key is to be proactive. Companies need to build transfer pricing considerations into their overall strategy right from the start.
So it's not something you just tack on at the end.
Exactly. It has to be part of the DNA of the business. And these days, technology plays a huge role in making all of this happen smoothly.
Right, because we're talking about these really complex operations and tons of data, right?
Oh, yeah, and trying to manage all that manually. Forget about it. Luckily, there's some seriously sophisticated software out there that can do a lot of the heavy lifting for you.
So you've got these tools that can collect data, analyze it, generate reports.
Exactly. They're lifesavers for companies trying to navigate this whole global transfer pricing maze, especially in a place like Singapore.
Okay, so as we wrap up this deep dive into related party transactions in Singapore, what's the one thing you really want our listeners to walk away with?
It's this. Related party transactions can be complicated, no doubt, but they also offer a unique blend of challenges and opportunities. By really understanding the rules, thinking strategically, and using the right technology, companies can not only survive in this landscape, but actually thrive.
Couldn't have said it better myself. We've covered a ton of ground today, but remember, this is just the beginning. Transfer pricing is constantly changing, so keep learning, stay curious. And that's it for this deep dive. Thanks for tuning in, everyone.